This one mistake could cost you millions of dollars when you ultimately sell your business. I'm Arthur Petropoulos, managing partner here at Hillview Partners. We're a middle market, lower middle market, M&A and capital advisory firm helping companies and owners of companies generating $1 million to $10 million in pre-tax profit to exit their businesses to secure capital. Generate 50% better returns over a 6-month process, start to finish, selling companies, finding capital, and optimizing value, structure, transition, stakeholder and employee considerations. And so oftentimes we've chatted with people that have already sold their businesses, people that knew someone that sold their business, and they said, yeah, it was a great deal. We sold the company at 6 times. And we'd say, 6 times what? They'd say, oh, our EBITDA. And say, well, did you adjust the EBITDA? Did you normalize it? Did you recast it? What modifications did you try to make to it? They go, no, just EBITDA. It's a pure equation. It's just the earnings, adding back the interest, taxes, depreciation, and amortization. And say, okay, well, did you have personal expenses going through the business? Yeah. Did the business function the same way every year? Well, no, there were different things every year, but they took an average of the last 3 years, and so that was what they multiplied the multiple by. And so we'd say, okay, so they took an average of the last 3 years EBITDA, not adjusting it for anything personal, non-recurring, one-off, or anything like that, and they applied a certain multiple, a 6 times multiple, to that number. And I said, yep, that was what happened, and that was a good outcome. And look, it's not necessarily a bad outcome. That doesn't mean it's not a 7, 8, 9-figure transaction. However, the one secret in this business that can cost someone selling a company millions and millions of dollars is that the EBITDA multiple is just one factor. What you are multiplying it by can have a meaningful impact when ultimately exiting a business. So let's go into an example here. Company A does $1 million in EBITDA 2 years ago, $2 million of EBITDA last year, and $3 million of EBITDA this year. Now let's say we're in December, so the trailing 12-month period is truly January to December. And so now within the business as well, and we're going to use some round numbers here, every year there's about $333,000 of personal expenses that are expense for the business. There's about $330,000 of expenses that happen every year but are very unique to the current ownership. It would not be the case for future ownership. And let's say every year some one-off situation happens. Obviously this is large for this example, but we're using round numbers, of $333,000. And so every year there's another $1 million that is not baked into the traditional calculation of EBITDA, however it is unique or idiosyncratic in some way. And so buyer of the company comes along and says, okay, let's take the pure EBITDA calculation and let's average it over the last 3 years. So if year 1 was $1 million, year 2 was $2 million, year 3 was $3 million, let's take the average of that and say it's $2 million a year. Let's apply a multiple of 6 times to that. Value of the business, $12 million. Now, let's take an alternative situation and we'll break down each variable of this mistake that can cost a lot of money. One is timing. And so, yes, in 1987, did all private equity transactions buying brick manufacturing companies look at averages of multiple years of EBITDA? Sure. But you had track records of 50 years. The growth in the businesses was completely different. The industry dynamics were different, and the capital dynamics were different. So in our situations, we really want to look at what is the trailing 12 months of the business? Is that consistent with history? And then for companies in this $1 to $10 million range, if there are increases to EBITDA over time and there's rationale or support as to why those increases are permanent, then really it should be a very narrow time frame historically, if not even baking in a bit of the future into what that EBITDA should be. So let's just take for a simple example, this 1, 2, 3, our situation, we look at the timing of just the last 12 months. So let's say $3 million is the baseline EBITDA. Now, variable number 2, personal expenses. Some businesses have more personal expenses going through them than others. Personal preference, obviously there's some tax implications or savings, but let's say in that $333,000 of personal expenses. Now, if you were to run that kind of personal expenses through a business and then sell the business to someone else, would your personal expenses be continuing with the business post-transaction? Simple answer is no. So shouldn't that be added back to EBITDA because that's going to be cash flow for the acquirer of the business, right? And so, variable number 2. Now EBITDA went from $3 million to $3.33 million. Next, let's say there's a expense that happens every year. You have a very large legal expense, whatever the case may be, but it's a recurring situation that would be non-recurring to a new acquirer. Now, this is a negotiated point because if you have legal expenses and you say, well, they have their own lawyer, they're going to say, well, you're going to be utilizing that lawyer with your legal things. But if there's something unique about the expense to your business that is just not going to recur going forward, and there's lots of these types of situations that you really have to go through line by line as we do to figure out, well, if it can truly be argued to be a non-recurring, then that should be added back. So now we're going from $3.33 million to $3.67 million. Lastly, let's just say there was a lawsuit settlement this past year for $333,000. Let's just say there were some expenses that came along with the sale of some equipment, expenses that came along with the closure of a separate business that was under the same umbrella that has nothing to do with the core business. There's a lot of these one-time expenses of a business that can also be added back because, again, is this to occur to the future owner of the business? Now, if they say, look, you say it's one time and there's always this same one time, that doesn't mean it's not going to be accepted. It's just going to be negotiated, and there has to be a very strong case as to why it's not going to be the case for future ownership, and there certainly are cases to be made for that. But let's say if we can justify that, then now we're talking about $3.67 million going to $4 million EBITDA. So let's say if we were to apply the same multiple of 6 times to this new $4 million EBITDA figure, this adjusted, recasted, or normalized EBITDA number, we're talking about a value of $24 million versus $12 million for the same company, generating the same figures, applying the same multiple. And we would take it even one step further, that if we had an adjusted or normalized EBITDA of $4 million, we would argue that the multiple warranted on that, because we would be able to talk to larger acquirers with lower costs of capital, should be higher. And so maybe it's 7 to 8 times. And so let's take the high range of that just to illustrate the distinction here, is that if you said we're going to multiply 8 times by $4 million of EBITDA, you have a value of $32 million versus 6 times the original $2 million of EBITDA was a $12 million figure. And so in this same company, we're talking about a value difference of $32 versus $12 million, a $20 million value. So you're talking about almost twice as much as the value in the first situation being the delta. Look, not every situation you're going to have such large add backs. Not every situation you're going to have such a growth curve relative to EBITDA every year. However, each of these components is going to be present in almost any situation, and it needs to be characterized the right way, because everybody would love to buy a business for a strong multiple of an unadjusted number, because at the end of the day, someone can walk around and say, we sold for a good multiple, so I feel good about it. But in reality, not only does the multiple have to be aggressively negotiated, but so does the actual normalized EBITDA figure, because that has a material, if not sometimes more than the distinction in the multiple, impact on the valuation of a business. So to recap these 4 variables in normalizing EBITDA, in avoiding this mistake that can cost 7, 8, 9-figure sums in a transaction, that can cause 7 or 8-figure losses in a transaction, are A, the timing, B, the personal expenses, C, the non-recurring expenses, and D, the one-time or one-off expenses. So to avoid this critical mistake, you have to focus on the multiple being applied to the company, but also recasting the EBITDA in a way that is justifiable, that is substantiable, but adequately reflects what the cash flow generating power of the business will be to the next acquirer, not necessarily to the existing acquirer. That, some of the magic of the business, and what we focus on every day when advocating for our clients to maximize the value in their exits. So hope the week continues to go well for everyone. Keep pushing forward. God bless. We'll see you next time.